Subadra, let's start with you. CPI, let's go. PPI, let's move. Retail sales, okay. How bright is that green light for the Federal Reserve?
Pretty bright at this point, given the fact that I think there was some concern, at least from me, that there might be a slowdown in growth in the first quarter because of, the Omicron variant, weaker retail sales, perhaps weaker consumer spending, weaker services sector. But that doesn't seem to be really being borne out in the data. Thus far, the data, both manufacturing as well as the services side of the services sector, seem to be holding up okay, given the fact that we've seen a pretty decent surge in the Omicron variant. So it's mostly green light for the Fed. The question really becomes one of whether they raise rates by 25 basis points on a measured pace for the remainder of the year, or they kind of switch to a much more aggressive stance and start raising rates by 50 basis points, either the March meeting or one of the subsequent meetings.
Bob Michele, you think this Fed has got some catching up to do?
Yeah, I think they do, and I'll confess, I never liked the idea of a 50 basis point rate hike. We look back over the last 30 plus years, there have only been a couple times they did it. In 99, 2000, they raised rates 6 times into the dot-com bubble. The last one was 50. In 94 to 95, they raised rates 7 times. The last 4 were mostly 50, but they threw in a 75. So I've always viewed a 50 basis point rate hike as serving the market a knuckle sandwich, and that's about what we're going to get.
You think we're going to get a knuckle sandwich middle of March? Bob Michele, you're looking for 50 basis points.
Yeah, and you know what? If they don't do it, they're going to disappoint us and everyone else in the market, and it's going to unanchor a lot of things across markets.
Well, initially, some people might say, who cares if we're disappointed by it, Bob? What do you think the complications, the consequences will be?
Well, I think the consequences of not doing 50 are a steepening of the yield curve. I think that any thought that you could invest in risk on through credit or equities, that goes out the window because the market will lose confidence in the Fed, that they're too far behind the curve. And look, so far this year, the Fed has admitted they are way behind the curve. Inflation is much hotter than they thought. They have a lot of catching up to do. And that starts with a 50 basis point rate hike in March.
Wow, Matt Hornbach, I'll use Bob Michele's words. Do you expect a knuckle sandwich next month?
I expect this year to give us ice cream sandwiches, John, and it's ultimately because the markets are pricing in just over 40 basis points for March. And the equity market, of course, knows that, and the equity market has been okay, right? We're a handful of percentage points off the all-time high, and we're dealing with geopolitical risk as well infused into that price. So I think the markets are prepared for a 50. I agree with Bob. I think if they deliver less than what the markets are hinting at in their price, then that will amount to an easing of monetary policy. And this is not the environment to be easing monetary policy, clearly. The other observation I'd make here, John, is the type of economic data volatility that we're seeing today is more reminiscent of what we see during recessions, not recoveries. So the Fed really needs to get a handle on what's happening in the economy. They need to hike 50 basis points, I think, in March.